What up, friends? We are going to talk about different loan types for residential purchases today. So there's 5 different loans I'm going to be covering. First is conventional. Second is jumbo. Third is government issued loans. Fourth is a fixed rate mortgage. And 5 is an adjustable rate mortgage. So let's start with conventional loans. Conventional loans are typically the most common loan that's used, and usually you'll need to have about 20% down. There is some new conventional types of loans that only need 3.5% down. Conventional loans are a great option if you have a decent credit score and a decent down payment. They're also a better option as far as the seller is concerned. They don't have to deal with as many things that could potentially go wrong with like an FHA loan. So sellers usually would choose if they had everything the same in one offer as the same as the other. If all the terms were the same except one had conventional and the other one had FHA financing or some other governmental issued funding, most likely the seller is going to go with the offer that has conventional financing. Jumbo loans can be used to buy higher priced homes. You do need to have a 10 to 20% down with a FICO credit score of 700 or higher. You cannot have a debt to income ratio of over 45%. And you also must show significant assets in cash or savings accounts. Again, these are for higher priced homes, and the interest rates are usually pretty competitive with other conventional financing. Now I'm going to talk about 3 types of government issued loans. The first one is FHA loans. These are a great option for people that might not have as high of a credit score. You can have a credit score of usually a minimum of about 580. And you can get financing for 3.5% down, which is way lower than most conventional rates. Again, there are some conventional that can go as low as 3%, but FHA loans are backed up by the government, and a score of 500 can be accepted if you have at least 10% down. Now, USDA loans, these type of loans are more for rural areas, and I believe with USDA loans, you can get in with as little as 1% down. VA loans are only if you're in the military, and those are going to be basically special perks to being in the military, and you can get into a property with like 0% down, and sometimes the closing costs and all that kind of thing can be lower with the VA loans. Now, the next one is fixed rate mortgages, which I personally prefer. Fixed rates are nice because you can know what's expected. You can know that what your interest rate is going to be. It's not going to go up and it's not going to go down unless you are to refinance. Adjustable rate mortgages, those are a little bit more risky, and the reason that I personally don't like those is because yes, it could potentially go down, but it could go up, and I just like to have things planned and know what I'm going to be spending. So if you don't mind a little bit of a risk and you think the market is going to be going like the opposite direction where rates are going to be going down, then you might consider an adjustable rate mortgage. I do know that adjustable rate mortgage financing, sometimes that's the only option if you're getting, like, for instance, commercial lending or business lending. A lot of times that's the only thing that's offered, and fixed rates are not offered for that. So I hope you guys enjoyed this video. Hopefully some of this was helpful to you on what you can do to expect when you're looking for different types of financing for residential properties. If you guys know anybody that has any questions or needs any help with the home searching, selling, or if they're interested in being a realtor, hit me up. My contact details are here right up at the screen.